Welcome Bill and Rangu virtually, and then Madonna and Dave here in person, and those of you in the audience. I'm going to dive right in, and we'll explore a number of topics that hit on data center development and financing and operations globally. I'm going to start with you, Rangu, and maybe you can introduce us a little bit to Princeton Digital, which countries and metros you currently operate in, and what are some of your most recent milestones as a platform. Welcome.
Well, thank you, John. Good to be virtually on the panel. Unfortunately, can't be there live. Miss being there. Princeton Digital Group was founded less than 5 years ago. We are backed by Warburg Pincus, the New York-based private equity firm, and then also we have Ontario Teachers as one of our institutional investors who came in last year. We are headquartered in Singapore, and we are a pan-Asia operator. And we are today in 5 countries, in China, Singapore, Indonesia, India, and Japan. Together, we have a portfolio of 20 data centers, which are in various stages. 10 are in operation. The other 10 are in various stages of development, totaling about 600 megawatts across these 20 projects and in 5 countries. So we are been building this portfolio across these markets simultaneously. So there is no particular home market except that Singapore, we happen to have an asset here as well, and we are headquartered here in Singapore. And as I mentioned, we are privately held, and our customer base is largely hyperscalers. So we are focused on the hyperscalers, the US hyperscalers in Asia, as well as the Asian hyperscalers in Asia. And so that's been our target market, and the scale of the growth has been driven by our investment approach, which is acquisitions. We do also telco carve-outs from telecom companies, and a large-scale development, greenfield, bottoms-up development. In terms of the cities in these countries, some examples, we are in Shanghai, Beijing in China. We are in Mumbai in India, and in Indonesia, we're in a couple of sites in Jakarta. And in Tokyo, Japan, we just announced a couple of months ago, a 100-megawatt project outside Tokyo in Saitama City, which is north of Tokyo, which is our latest project that we announced. And in Mumbai is a 48 megawatt, which is in Navi Mumbai, just outside the city. So that's kind of the back. Go ahead, John.
Yeah, thanks for that. Thank you for that overview. Great overview. Thanks for that. And as you think about your future growth strategy, you've already talked a little bit about buy versus build. Going forward, kind of what are the priorities? Are you going to focus on the existing markets that you've mentioned on, or are there other parts of APAC that you find attractive?
Sure, John. I think our approach for growth is continue to expand in the existing markets, as well as grow into new markets. For example, in the existing markets in China, we just recently acquired a 66 megawatt project outside Beijing in Langfang area that you may be familiar with, as well as looking at other locations in India, which we'll be announcing this year. So we continue to deepen and expand in the existing markets and also enter new markets. So we are looking at countries like Korea, which is of high interest to our customers. So some of our expansion strategy has been driven by our relationship with some of the largest hyperscalers, which give us some good insights about their investment plans, which lead us to looking ahead in terms of our opportunities and where we want to bet on. So Korea is an example that has been on a customer's mind for a while for us to look at. So that's a market, for example, that we will be expanding into, and maybe other markets like Philippines that we'll be looking at.
Thank you. So great overview of a lot of Asian markets. Bill will have a chance to kind of comment as well, but I want to maybe kick it over to Dave from CyrusOne, US and Europe. Talk to us a little bit about the major demand trends you've seen over the past 6 months. How do you see demand, hyperscale demand, enterprise demand unfolding for 2022?
Sure, John. Broadly speaking, we are seeing demand across the US and Europe in both our enterprise at scale as well as our hyperscale. We kind of focus enterprise at scale. We kind of define it as a megawatt or higher, and then the hyperscale is all the hyperscalers. We have seen in Europe much more hyperscale demand than in the US, although we see lots of demand across both markets. I think with respect to the outlook, it's always been really difficult. We work really closely with our customers to try to demand understand where their demands are and what their capacity requirements we're going to have. Looking out, it just takes longer to develop in Europe. So in Europe, our conversation is, a much longer horizon conversation to where we can have a conversation around capacity requirements, whereas in the US, things are happening a little quicker. I'd say that the market has shifted over the last 6 months, and that 6 months ago, we did more bookings in the US. At the end of the queue, we've got about 50, at the end of the third quarter, we've had about 50-50 between US and Europe. But the third quarter alone, 71% of our bookings came from Europe. So, we're seeing broad, diverse demand across both regions.
So you operate in Texas, Virginia, among other places that are very accommodating for development. Educate us a little bit about Europe and what are some of the major differences, either in terms of competition, ability to procure resources, develop capacity, any notable differences that you see?
Significant notable differences. It's just much more difficult to get the land, get the power. The regulatory process in Europe is more difficult. We think about a project in Europe, that Gantt chart is a much longer project than a project in the US. And it's across all components of the project. So, fundamentally, we think about development very differently in Europe, and our goal is to be a lot more proactive, and we have to think further out and buy bigger scale and work with the power providers. And, we're 100% renewable in Europe, so we don't want to blemish that. So I would say that, across the board, we have to plan ahead and be a lot more thoughtful in developing in Europe.
Thoughts on Asia? It's kind of been talked about over the years.
Sure.
You don't currently have anything other than maybe a partner presence in Singapore, a very small one, but anything in terms of developing your own platform?
I think we announced last year at Investor Day that, Asia was on the horizon. I think we announced, 3 or 4 years. My instinct is we're going to accelerate that a little bit. We definitely want to be there. Our customers want us to be there, and so we will begin, putting those plans in shape.
So there's obviously been a lot of M&A in the sector, as well as take-private transactions, including one of your peers, as well as your company as well. What changes do you anticipate as a private operator backed by global infrastructure funds such as KKR and GIP?
Number one, thank you. It was a great transaction. Our future partners are fantastic, and we're excited about that next chapter in the company. We really don't want to comment on that until after our shareholder vote in a couple weeks. And so I think, projecting how that's going to look, that'll come together really quickly. But, between now and then, we're still a public company, and I still have, I think we want to wait to get through the shareholder vote.
And then finally for you, before we have Bill and Madonna have their say, but maybe talk a little bit about construction timelines, customer move-in. Supply chain has been a topic throughout COVID. I think it's affected different sectors of the economy differently. What has been your experience so far, and anything to be mindful of as we look over the coming year?
Yeah, look, everybody, whether you're in the grocery business or any business, I think there are impacts to the supply chain. What we're doing to be able to answer the question, hey, we're not having any major impact, is we've kind of have a 3-pronged strategy when it comes to the supply chain. Number one, we're working with as many vendors at each component as we can, so multiple vendors, dual sourcing. Number two, we're being as proactive as you could possibly be. We're procuring equipment now out till, well into 2023, even out towards the end of 2023. And the last thing we're doing, which I think is, really helpful, is we just have to work with our customers. We've got to coordinate with the customers. Our development pipeline's 86% pre-leased, so we know who is going where. And so all the coordination with the customer will help. So far, no meaningful impacts to our supply chain. How that's going to change, time will tell. But it's not an accident. We're trying to, use our capital and use our influence and use our customers to help us. Our customers have significant procurement groups as well. And so we just have to collaborate and do everything we can do to be proactive. But I'd say 2 years ago, we didn't have to do any of those things. So there's been a material shift, and we are just trying to make that part of our strategic conversation, whereas 2 years ago, 3 years ago, procurement and supply chain was just part of the business. It's now a strategic part of the business.
So we might have time for audience questions. So if you want to make yourself visible, I'll try to call on you, time permitting, if we have any at the end. But for now, I'd like to ask you a couple of questions. Bill Stein from Digital Realty. M&A, you've been quite active in terms of joint ventures, acquiring companies. Give us a little bit of a flavor for what the rationale was behind India, Nigeria, Korea, and then I think most recently you were on the very first business day of the year, you announced a transaction as well. So tell us a little bit about your growth strategy internationally.
Happy to, Jonathan, and good to see you virtually. Sorry I can't join the three of you in person, but hopefully next year. First, we at Digital are committed to expanding where our enterprise network and cloud service provider customers want to grow. So our entry into India, Nigeria, and Korea is a continuation of our global expansion that began in 2018 with the acquisition of Ascenti, which has grown significantly in Brazil, but has also expanded into Chile and Mexico. All of this complements our combination with Interaction that occurred 2 years ago, and that significantly strengthened our competitive position across Europe and has expanded to include Croatia as well as Greece. The key takeaway is that we believe Platform Digital should be a globally pervasive platform of co-location, interconnection, and hyperscale product offerings. I'll address Nigeria in a moment, but first, relative to Terraco. Terraco is Africa's leading carrier-neutral co-location provider, and is another example of our belief put into execution. It's based in Johannesburg, South Africa, and we think it's a great example of expanding into a highly sought-after market and partnering with a highly accomplished management team, as well as existing investors. Let me address each of our recent expansions briefly. First, relative to India, BAM Digital Realty was announced last July. It is our second joint venture with Brookfield. India is the world's 5th largest economy, rapidly digitizing with a population greater than both the US and Europe combined. And we'll be announcing more on this shortly. Second, Africa. Again, a rapidly expanding economy, ascending technology, manufacturing, and tourism sectors, and a young and increasingly urban population. Before announcing Terraco, we had a significant presence across Kenya with our iColo business. And to your question, in partnership with Pembani Remgro, an infrastructure fund, we also recently expanded into Nigeria, Africa's largest country by population, with the acquisition of Medallion Communications. In addition, we have a presence in Mozambique. Our acquisition of Terraco, meanwhile, enables us to better serve our customers across Africa, Europe, and Asia by capitalizing on interconnection-driven communities and submarine cable landings. South Africa is the largest data center market on the African continent and ranks in the top 10 of most connected and most heavily trafficked globally. Third, Korea. We entered this market with a build-out that we began last year, and next week we will be launching INC-10 in Seoul, the first truly carrier and fiber-neutral data center in South Korea. Before our entry, the Korean market had been served exclusively by Korean telcos. We believe our entry is an opportunity to level the playing field for our customers and to positively disrupt that market. We've also recently closed on land in the Gimpo area, which is about 23 kilometers outside of Seoul. We will connect this site to our downtown Seoul facility with dark fiber, providing competitive connectivity solutions for our customers beginning in the second half of 2023.
That's a lot to talk about that you covered quite efficiently. As you look at the challenges around developing incremental capacity, I wondered if you could comment on any tightening that you've seen around permitting or approvals by local jurisdictions, increased policy focus on environmental stewardship. We've seen that in places like Amsterdam and Singapore. Any kind of an update or major changes that you're seeing, either that make things more challenging or a little bit more smooth sailing going forward?
Sure. Well, certain select jurisdictions, most notably Singapore and also Amsterdam and EMEA and Silicon Valley in the US, have begun tightening data center permitting to various degrees. These restrictions impact our ability to deliver new capacity to meet customer demands in these markets. And we think it's quite possible that we'll see similar restrictions in more markets around the world. From a provider perspective, that's not entirely a bad thing. These restrictions serve to limit the availability of new supply, which obviously benefits pricing for the suddenly more scarce available existing capacity. Going forward, it will be critical for the industry to deliver more sustainable solutions to optimize resources and mitigate the impact on the environment. That's why we'll continue to prioritize our ESG work. First, let me remind everyone here that Digital Realty is the industry leader in sustainability and ESG more broadly, which our board and our management team are both very proud of. Whether on the environmental or diversity, equity, or inclusion fronts, we're committed to industry leadership and making continued progress. Second, a very important point regarding environmental stewardship is that regulation can stifle the innovation that's needed to help meet aggressive climate goals. Again, local municipalities are increasingly focused on sustainability when reviewing permits. We partner with policymakers in the communities where we operate and proactively incorporate sustainable practices in our building designs and ongoing operations. By working together, we're a big part of the solution. For example, last year, the data center industry proactively joined forces with cloud service providers to launch the European Climate Neutral Data Center Pact, an industry self-regulatory initiative with strong private sector commitments and policy recommendations. This pact will help the industry achieve carbon neutrality by 2030, importantly, without the need for government regulation or intervention. Lastly, Digital Realty also proactively set the data center industry's first science-based target, committing to reduce our global climate impacting emissions through renewable sourcing, energy efficiency implementation, and green building design. A recent example of this, which is, I think, pretty cool, is our river cooling project in Marseille, France. We were able to work with the local community there to develop a highly efficient, innovative cooling solution for our data centers that utilize cold underground water from a 19th century industrial mining facility. This saved up to 18,400 megawatt hours annually while improving the PUE of our data centers, but eventually supplying heat to homes and offices in the local community.
Thank you for that. And I want to, again, poll the audience to see if there's any questions. Raise your hands if you have any, and I'll try to get to you if we have time at the end. But over to Madonna Park, in your role at RBC, you've seen quite a lot of transactions. What capital raising trends have you observed over the past year across the digital infrastructure landscape, and any changes you anticipate over the coming few years?
Sure, thanks, John. I think, over the past few years, we've seen a lot of changes in both equity and debt markets for the data center space. So, for example, call it 5 years ago, this is largely, on the private side, largely a private equity-driven sector. And today, the infrastructure funds have completely displaced all of the private equity funds on the equity side. And we've also seen a lot of the sovereign wealth funds, pension funds, who typically aren't direct investors, looking to make direct investments in this sector. So some have been more successful than others, but what we have seen is just a very large pool of capital from mega infrastructure funds and sovereign wealth funds, a lot of equity, looking for opportunities to invest in this space. And then on the debt side, I think for companies like Digital Realty or Equinix, the biggest companies, obviously they're all investment grade and have very good access to very efficient debt capital as well as equity capital. But on the private side, I think what we've seen over the last few years is the ABS market and the CMBS market more recently have come into play and have created a deep pool of very efficient debt capital for private companies that I think, Dave, I'm sure you're looking forward to having access to that going forward. And I think, it is a capital intensive business. And I think, the continued evolution here of providing those types of structures and at an efficient cost basis will be good for the industry.
And then looking beyond data centers, how, in your view, do investors and issuers view the prospects for data centers versus towers, fiber, other types of asset classes that Mark Gansey addressed in his remarks in terms of return expectations and just overall attractiveness?
I think, the underlying fundamental growth drivers are similar for all of the sectors, right? So it's, whether it's cloud or it's 5G, the underlying, trends are the same. But I think, an industry like towers is more mature at the end of the day. And I think, more well understood. And I think investors are willing to accept a lower growth profile from that sector just because of, it's steady, it's understood, and, mature. I think the data center and fiber industries are equally critical to the global communications infrastructure, sector. And, all of those sectors together help us, do things like having a partial Zoom, in-person conference like today. It's, happened pretty seamlessly. A few years ago, pre-pandemic, it would have taken like IT people, I don't know how many man hours to even try to figure something like this out. So I think people have recognized over the last few years that these are critical infrastructure, but I think the data center and fiber sectors are still maybe a little less mature, and people or investors are probably still, there's a range, right? If you're building a data center for Microsoft, then maybe you're willing to accept a very low return because it's a long-term contract and you have a very creditworthy tenant. But if you have a group of data centers with more retail customers and some churn, all of that, you probably do expect more return for the risk that you're taking. So I think it does, there is a range there, and not, the sectors are not exactly the same. There's some convergence that we're seeing now with American Tower acquiring CoreSite, but I think that's still early days. And we've also seen deconvergence in this sector, with Zayo and Zcolo that that had come together like a lot of telcos had done in the past, and we've seen the telcos all divest their data center assets. But now with the emergence of edge, they need data center space again. So who knows? There might be another cycle of some of this coming together, like American Tower and CoreSite.
Audience questions. Far right, Colby.
Hello. I have a few questions. One is, Rangu, you said you're in China. If you look at the publicly traded Chinese companies, those data center stocks have gotten absolutely crushed over the last year. I'm just curious what you think's behind that, and does that apply in terms of how your business, and is that a higher risk decision-making process? You said you actually just expanded there. And then for Bill, as you go to more emerging markets for growth, how do you think about the return profile that you're looking to achieve in those markets relative to some of the more mature markets that you've historically been in? Thank you.
Thank you. So a couple of things on China. I think the public companies which have been under pressure have been for different reasons. One, there has been a lot more China headlines which are not necessarily fully understood. The impact of those tech companies, how it translates down to demand on the ground. So I think that has not been fully understood. I think there is a little bit of discounting going on for that reason. But more importantly, two other factors that's playing in is one, China-only exposure. That's kind of what the market is recognizing, is the capital is moving more towards a broader regional exposure. So I think there's a shift of capital that is happening. You're seeing a lot more tech companies out of Southeast Asia, for example, which are multi-country, getting a lot more premium than China-only kind of situation. And lastly, there have been companies where not only they're only China focused, but a lot less revenue diversification. That's impacting because some of those clients may be under pressure for various reasons. So if you look at it holistically, I think as a sector, yes, they've been under a little bit of pressure, quite a bit of pressure this year or the last 6 months. And now coming to a company like PDG, we have a good China exposure, but at the same time, we have a pretty broad-based exposure from a capital perspective as well as customer contracts perspective. So good news is a lot of Chinese hyperscalers are aggressively expanding across Asia, outside China. So a company like PDG becomes a very valuable partner to grow with from China to rest of Asia. And also for other global hyperscalers who are operating in Asia, we are a very natural partner in China, but also in rest of Asia. So overall, PDG is benefiting from the overall Asia growth, as well as being a multi-country operator. So those are a couple of things that's helping PDG gain a much broader market share gain compared to our peers or competitors out there. So hopefully that was helpful.
Thank you.
Colby, relative to our hurdle rates for emerging markets, we always add at least a couple hundred basis points to account for emerging market risk. In the case of both Ascenti and Terraco, both platforms had relatively low current returns, but with a substantial growth component. I mean a significant growth component. Ascenti has been realized. It's more or less on plan. We would expect that Terraco will also generate much higher growth than you'd see in a traditional domestic U.S. or even European portfolio.
I think we had another hand go up. Yes.
If you had to attribute for the data center operators a percentage to your customers' desire for ESG goals to determine whether they would co-locate with you newly or churn, what would that be? And on the money side of the house, both on the equity and debt side, what are investors saying about whether or not they will invest based on ESG goals, and are their KPIs tied to that debt financing? Thank you.
So, so to paraphrase, to what degree are customers asking about ESG and environmental when they decide to co-locate? And maybe we'll start with Dave, Rangu,
Sure.
Bill.
So across the board, ESG,
2 minutes. Yep.
ESG is a huge initiative, and it's from all stakeholders. And the ESG process internally is only getting more and more mature. And so there are KPIs, there are metrics, there are different components of the business that we look at that we think of, okay, these need a little bit more investing in. Here are some goals we're hitting. But across the board, all stakeholders have an interest in this, and it's a big part of our culture. So there's just nowhere to run, nowhere to hide. Measuring things is the only way to make them better. And across the board, this is becoming a bigger and bigger part of the business, at least from a CyrusOne cultural perspective.
Rangu.
Yeah, a couple of things. One, from a customer perspective, Asia is overall a very challenging market. Each of the geographies within countries, states have very different policies around green and renewables, as we know. And they are now depending a lot on operators to really help solve the problems, unlock some of the issues. And so I think what we are seeing is companies, operators, data center operators, who are a little bit higher in the game, working through with policymakers and local regulators to get a much better appreciation of the emerging regulations around green power is helping a lot to win customer confidence on new projects and new business. So I think that, and for example, with PDG, we got in Jakarta pretty early on to get REC from local utilities as an early start into the market, but that gave us a lot more room to work with local market, and customers recognize that, for example, as a very important aspect of what operator like us and others would be doing in the market. Second, from a debt perspective, from a capital markets perspective, our debt is relatively growing quite a bit in Asia. There's a lot more understanding of the debt market, but also overall debt market, but also we are seeing new products like green bond coming in. I think that we believe will play a significant role in terms of incentivizing the industry to do a lot more around green. And lastly, of course, being private, our investors are taking a lot of lead in pushing us beyond norms. So firms like Ontario Teachers, which is a market leader in terms of institutional investors, focusing on green. So all three aspects of our stakeholders are playing a big role in our strategy for ESG and what we're doing on the ground.
And then, Bill, you get the last word on from both a customer standpoint and maybe investor stakeholder standpoint.
Well, I mean, from a customer standpoint, I would say that ESG is table stakes. Now, a few years ago, it was being driven by the cloud service providers, driven in the sense that their values, if you were consistent with ours. Now the enterprise customers are very sensitive to ESG issues as well. So I'd say across the board, I would characterize ESG as table stakes. Relative to debt and equity, we're the largest issuer of green bonds, and most of our green bonds have been euro denominated. So that's there clearly there's lots of capital that wants to focus on debt that is tied to various green initiatives. And from an equity standpoint, there's specifically ESG funds that invest in companies that care about those issues. But I'd say more recently, the dedicated REIT investors and the generalists are focused on ESG issues. So you do have dialogues with the ESG teams associated with these funds that are focused on those issues.
That unfortunately was the last word. We're out of time. I want to thank all the panelists for their remarks and appreciate the audience participation as well. Thanks, everybody.
Wonderful. Thank you so much.
Thank you.